Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters and Associates, as well as the Chief Investment Officer. As always today, I am joined by my fellow partner and the head of our investment committee, Brian Bortz, and Brad Sanders, the Managing Director of Tectonic Advisors. This is your July market update. For the month of July, the S&P 500 was up 2.2%, though it was certainly higher until the last few days, which we'll talk to Brad about. Global stocks were up 1.3%, and then domestic bonds down 0.3%, and global bonds down 1.5%. So, Brad, I'd love to come to you. As I mentioned just briefly, seemingly for the month of July, it was sort of this slow move higher, almost kind of lulling us to sleep as investors. We had some really good earnings come out from the S&P 500 companies, and it really did appear all the way up until the last few days of July that the month was going to do considerably better than it ended up at. And then all of a sudden, just the last few days, things cratered out. We did still end up positive, but we want to talk a little bit about what caused that crater and then kind of what things we take from that as we head into the fall.
Yeah, I mean, in investment parlance, we call it an air pocket. And it's just basically when you have a market that steadily marches higher and you don't really have the fundamentals keeping up with it, you get a pocket between reality and valuations. And so any deviation from trend can cause kind of a collapse of valuations really quickly. And that's just kind of what we saw. I bet if anybody out there that listens to any of my weekly talks, which I do, I've been kind of talking about this for the last 6 to 8 weeks. How I felt it was a little bizarre, the level of complacency that had set into the market, given the uncertainty overhang that's out there. You still have trade deals to be done, and tariff policy, and geopolitical, and you kind of all down the line, and interest rate policy. And there's just normally on a checklist you have one or two things. There seems like there's 8 to 10 right now, and for the market to just be kind of doing this melt up in that scenario didn't feel sustainable. And so I think what you saw, underneath the market, the S&P ended up, like you said, 2.2, but the Mag 7 was up 5.5. And if you take those out of it, I think the equal weight S&P was up about 0.5% for the month. So the broader market really didn't do anything. And you saw a lot of big moves from stocks. There'd be days where certain stocks are down 25, 30%. Which is just usually a sign to me that the market's a little tired. I've been saying I kind of had circled on my calendar that August was going to be a volatile month. We're recording this on today's the 5th, I believe, and it certainly has started out that way because you had the tariff policies kicking in, and August seems to always be a tough month for the markets. And you just had a lot of this uncertainty stuff just kind of convalescing into this month. So I think August is going to be a little bumpy, but bumpy is not always bad. It just, you just need to get some of the complacency kind of sucked out of the valuations, and then you'll, kind of start marching back higher, I think. Yeah, I just think, July really only needed to pay attention to the last week. The rest of it was kind of boring, melt higher, which we all like, but it just didn't feel sustainable the whole time.
Yeah, it's not too dissimilar from an NBA game from that perspective. Only the last couple minutes matter. Thanks for that, Brian. I'd love to come over. I'd love to come over to you, sort of to talk about. Okay, we still have a very positive market, but we're starting to see some consumer data come back. A little bit more negative. We obviously still have, as Brad mentioned, tariff policy that is outstanding. The Fed has remained in a pause pattern on rates. But certainly, folks are still kind of anticipating one or two cuts as we head into the end of the year. So, you want to talk a little bit about what data we're seeing on the investment committee side, and how we're kind of thinking through these next 5 months or so in the market?
Yeah, thanks, Hunter. Looking at the data, jobs are weaker. Jobs, as Brad mentioned in his weekly investment update, the jobs numbers have even been revised lower and also missed those lower revisions. Inflation is being obstinate. It's in the high twos. Tariffs are now in place as of August 1st. Thank you very much. Unemployment is 4.2%, and the Fed has taken all that data, put it in a pot, stirred it all around, and did absolutely nothing for 5 straight meetings. So that's where we are right now. The Fed has not changed their rates or their policy. I do believe that there's a very strong bias that you will see some lowering of rates, maybe a quarter point at their next meeting on September 17th. More to come on that. But as investors and clients of ours, just understand that ultimately what matters are earnings and the economy. And earnings have still been pretty good, and the economy is still growing at a 3% pace as of the second quarter, which is typically a pretty strong GDP number. So, some of the things that are out there, the trade deficit is at a 2-year low. If you look at the trade gap with China, it's at a 21-year low. All that sounds like really, really good, except for the fact that all that means is that the tariffs are now in place and that we're not exporting. We're not importing as much. So, from that perspective, I think that there is a heck of a lot of conflicting data that says, as Brad just mentioned, that this kind of glow up of the market really is not justified by a lot of the numbers that are out there, and you're probably going to see some volatility. So, as clients of ours, I think you pay attention to that. There's no reason to make any vast changes right now because we've already planned for this. We've been talking about it for the last couple of months. Our portfolios are well positioned, and I'm actually looking forward to getting through this and getting into the fall where you'll start to see hopefully some better economic data.
Yeah, lots on the agenda here as we head into Q3 and Q4. So as always, folks, thanks for joining us. We'll be back in front of you at the end of August, maybe when some kiddos are back in school. Thank you so much.